All right, so when we think of international diversification in the portfolio, because diversifying your portfolio has to be a strategy to mitigate your risk and obviously increase your return. And when we talk about international diversification or having that element in your portfolio, an obvious choice that comes in most of our minds is are the US markets. Now, talking about diversifying into international market and specifically the US market, it's a different asset class, definitely. Indian market has one of the lowest correlations with the S&P 500, and also talking about the kind of exposure that you can get is also very niche in terms of themes, especially the themes which are not available in the country. Is that something you might also want to have via US diversification in the portfolio? And investing in the US provides exposure to broader mega trends, that are still largely underrepresented in India, because we see those kind of trends and opportunities missing in our market. And also, one very important aspect would be hedging future dollar expenses. As India becomes more prosperous, the share of dollar expenses is likely to increase. And especially, if you are talking about lining up this particular investment to a financial goal, which in a lot of cases can be your child education or child education abroad, these kind of investment can really come in handy, because dollar-dominated assets can be useful to offset potential future dollars liability. So there are a lot of benefits out here in having an international exposure to your portfolio. The question obviously arises is that how much should be the exposure to these international equities? What should be the ratio? Or you also have to concern your risk which you might be taking, when you have these kind of international exposure. And we also know that the Reserve Bank of India has set a cap of 7 billion on investments in international equities through mutual funds. Now, having said that, a lot of these international funds are closed for subscription, in the sense you cannot do a new investment. As and when there is a redemption in these funds, you are able to put in new money. That's one very important aspect that's also hitting the investments in these kind of funds. But having said that, most of these funds that have US exposure, whether it is tax exposure, or today we are on the show, we'll be talking about ICICI Pru US Bluechip equity. They've given a double-digit return. In 1 year's time frame, also we've seen 10-12% return. So return perspective is definitely a good thing, but then the returns is here on your screen. So 1 year we've seen a 10.9%, 3 year is 9.8%, and 5 year is almost 16.7%. But how do you strategize this kind of an investment in your portfolio? That's a very important aspect. So let's focus on ICICI Pru US Bluechip Equity Fund. I have with me Chintan Haria, Principal Investment Strategy from ICICI Pru AMC. Chintan, thank you so much for joining in today. And we'll be focusing on ICICI Pru US Bluechip funds, and I was just counting the benefits of having an international exposure to your entire portfolio, and even despite that, having a US-based exposure, how beneficial it can be. Although we are aware of the RBI cap that has been put on international investments. Having said that, whenever there is a redemption, the fund is open for subscription or a new subscription for new money. But let's start by talking about the growth aspect in the US market in the current point in time, where we know the elections are around the corner. We know the kind of rate cut scenario as per the data that's coming up. There are experts talking about 2 to even 3 rate cuts, till Jan or Feb. But having said that, that's debatable and it's largely data dependent. Overall, how do you see the economy in current point in time? How can one look at US diversification in the portfolio? Chintan.
Sure. So when we look at, in general, investors making a bouquet of their overall investments, we normally suggest have a complete bouquet where a large part goes into asset allocation funds. Then you have the fully invested India dedicated funds, some allocation to mid and small cap, and international investing around 10% is generally what is the norm that people follow. And as part of international investing, because US markets are 50% of the world market cap, around $55 trillion out of the $100 trillion market cap, US is the favored investment, where mostly all the companies of the world, even if a company is based in China, say they may have an ADR in US. So US does give an opportunity for access to virtually everything that one would want to invest across the world, across all the sectors, and hence Back in 2012, we launched the ICICI Prudential US Blue Chip Fund because at that point of time, US had gone through the post-global financial crisis downturn, and it was one of the better investments. Now, if we look at it, of course, after 12 years of uptick, there has been some level of economic growth that US has already seen, and probably it is maturing enough right now to suggest that there is a slowdown which is imminent around the US election time or afterwards. Now, there are so many data points which keep coming out of US, but the latest data point, if we look at it, it does not look like a very bad picture as far as US is concerned. At the same time, it does not give us too much of upside hope in terms of the GDP growth in US. So, as an allocation, yes, US should be an allocation, but in a differentiated product, and that's where the ICICI Prudential US Blue Chip Fund, as and when it opens, of course, right now you mentioned it is not open for subscription because of the RBI caps. But as and when it is open, you can look at it because it's a very differentiated product, and that's how we always wanted it to be. So, US as an allocation should be there because there are so many sectors which are and so many types of companies which are available there, which may not be necessarily available in India. So, while the core allocation will be in India, you must look at US as an add on at some point of time in the future whenever the fund opens up.
So then talking about the mega trends that are working in the US market right now, if you could just highlight on that, because these are the trends that we really miss by having a domestic portfolio. So currently, what is the composition of the portfolio? What sectors and themes are we talking about that are doing well over there?
So if we look at the US markets and specifically the fund, if we look at the exposure wise, basic construct of the fund is 50 to 60 companies. Now US has thousands of companies which are listed across sectors. There are very large companies as well. Within that, if we look at the US blue chip, the way we manage it and we've been managing it, we choose those companies which have a very strong long-term sustainability or moat. And within that, what are the valuations or the cheaper stocks, the 40 to 50 cheaper stocks are selected across categories. So we do not necessarily look at the benchmark index or look at what's worked in the past, but select those 50 to 60 names out of the total US market, which have strong sustainable moats. These are companies which should remain in existence for 10 years, 15 years, because either a strong product or a strong brand or strong presence in the US economy. And if we look at those companies which are relatively cheaper among these companies, we are able to build a portfolio which valuation wise is also not that expensive. If we look at the construct today, it is majorly into consumer facing because if you look at the US market, almost 70 to 80% of the US GDP is basically uh, dependent on the US consumer. And so if you look at even the stocks or the portfolio as it stands right now, 24% roughly is in healthcare, about 20% is in industrials. There is technology, but it is only limited to about 16 to 17%. So unlike the US broad market indices where technology has become 35-40% of the indices in US, the US blue chip fund which we are managing has about 16 to 17% in technology. And the good part is that the portfolio is well diversified. So you have the topmost holding having only about 2.5 to 2.7%. It's a diversified portfolio, and the top 10 concentration is only 25%. Versus if you look at the broad market US indices, the top 10 concentration is 50%. So sectorally, it's a good mix of healthcare, consumer, be it discretionary and non-discretionary, and technology also. So good 20% across these names. Finance is a very low part of the portfolio, unlike in India, where finance is 30% of a general diversified portfolio. In the US blue chip, we have only about 6 to 7% in financial services. That's one big distinguishing factor because in US, we do not necessarily see a wide moat or any specific moat as far as finance companies are concerned. So the structure is such that it allows around diversified 40 to 50 holdings without any single concentration risk spread across sectors. And that's what over the last 12 years has made this product a good fit for investors looking for their long-term allocation to US. And we continue to believe that this should be added as and when it is open for subscription as part of an asset allocation for investors.
Sure, sure. Chintan, one last question, and I know you cannot talk about return expectations, but then having said that, because we are talking about an international exposure through US markets, this has to be a long-term bet. What should be your long-term average return expectation, looking at the double-digit returns right now that we are getting, how should one strategize in terms of having approximate returns in this kind of investment diversification strategy?
So generally, returns are a function of the entry point valuations as well as the GDP growth of that particular country or set of companies in which you're investing, belonging to which country. If you look at in the instant case, the US economy is not expanding meaningfully, and the inflation numbers are also coming down. So the nominal GDP of US is not growing at more than 3.5-4%. So logically, the US earnings may not grow beyond 10 to 12%. The expectation is the earnings growth will happen 10 to 12% in US based on estimates. And if that happens, and the starting point is about 23, 24 PE at a wide market in US, we don't see necessarily immediate returns being gratifying in US. India is probably a better destination as far as investment is concerned because of the GDP growth of 6 to 7% and the nominal GDP growth of 11%. US is not growing that fast. But if there is a significant correction in US, that is the time when probably you can look to add on. And the expectation, like you said, should be of maybe double-digit returns from an entry point, which is much cheaper. Currently, the entry point is not cheap as far as US is concerned. And hence, expectation of double-digit return may not be there, although none of us can predict returns. But the fact remains, the entry point should be such that it gives you enough cushion. And currently at 23 to 24 times. At least the broad market indices in US don't have that kind of cushion. India probably with a similar growth profile is available at a cheaper, slightly cheaper valuation and with probably better growth opportunities given our size is only about $4 trillion of economic size while US is much higher in economic size. So currently I would say in terms of economic cycle, India is in a much better shape while US probably has to go through a grind and maybe in the next 12 to 24 months, investors may get an opportunity to enter US, from which point of time they may get a better return experience.
All right. I do have a lot more aspects of this particular investment strategy to discuss with you, but then unfortunately, Chintan, my time is up. Thank you so much for taking time out and being a part of this interaction today. Thank you.
Thank you so much.
If you like this video, then like, share and subscribe to ET Now.